Coca Cola has just reported its earnings. Is it an undervalued, strong buy now? Let's take a look. As always, we'll run through the historical performance of the company. We'll look at their top line revenue growth as well as their bottom line net income. We'll look to their balance sheet for a quick health check of the company, total cash versus total debt. We'll see how they've performed versus their competitors and the industry over the last 5 years. We'll also see whether the institutions are still buying Coca Cola, and we'll understand why there is a significant amount of insider selling from the chairman and CEO. We'll also look towards the dividend safety. We'll look at their financial metrics, and we will run through their earnings report that they released this morning to see how well this company is moving along with the economy. And don't forget, we will run them through the valuation model, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety. And we'll look towards Wall Street to see what they're forecasting over the next 12 months. So let's start off by looking at the historical performance of Coca Cola. Now, it is essentially down just 0.3%, although it has been going up and down over the last few hours. Now, it is down 1.5% over the last year. Over the last 10 years, however, you would be up 61%. Do bear in mind this doesn't include those dividends reinvested, and we can see their all-time highs sitting around $66, which it has touched a few times over the last few years. It's currently in the midpoint of the 52-week range. You're looking at a yield of just over 3% and a forward PE of around 22. Before we look at the numbers, let's take a quick look at the earnings report, and we can see the headline reads that Coca-Cola sales beat estimates, which is helped by higher prices. So let's take a look at the numbers to understand how well they've performed. Earnings per share, 49 cents adjusted versus the 49 which there was expected, so it came in line. And their top line, nice to note, it was a beat, 10.85 billion versus the 10.68 that was expected by the market. In terms of their net income for the quarter, we can see it came to around 1.97 billion, and we can see that this is down from the previous quarter last year at 2.03 billion. So net income is down. We do see their net sales, however, up 7%, which is positive to see. And we can see their organic revenue up 12% in the quarter. Always great to note that. And when we analyze their volume cases of how much product they've actually sold, it is an increase of 2% for the quarter. Very positive to note, although we can see here that they do explain that the Middle East did hurt their volume growth by around 1% in this quarter. Looking towards their forward guidance then for 2024, we can see they are forecasting organic revenue growth of 6 to 7%, and an increase in their earnings per share of 4 to 5%, so mid-single digits. And we can see here that they are already anticipating around 4% of headwind from currency exchange rates. So let's take a look at the numbers. Now, top line revenue, remember what we want to see, 3 to 7%, especially for a mature company like Coca Cola. 34.3 billion reported in 2018, 43 billion in December 2022, and around 45 billion in 2023. So over the long term, it has increased. Very nice to note. On a more granular level, what we can see, increase to 2019, before a decrease in 2020, and then picking back up. So nice to know. You can arguably justify this due to COVID, the pandemic, but other than that, it has been increasing, and we'll look towards the percentages shortly in the financial metric analysis soon. Bottom line, the story that we can see here, pretty similar to the top line, 6.4 billion reported in 2018, 9.5 billion in 2022, and around 11 billion in 2023. So again, it is increasing, although we do note that increase to 2019. Before that, pandemic dropped to 7.7 billion, and then an increase relatively flat in 22, and then another increase into 23. So overall, both bottom line and top line is increasing. We'll look at the percentage wise too, just to ensure it is at that 3 to 7%. Quick health analysis, total cash versus total debt, 16 billion in 2018, 15.4 in their latest report. So whilst they do still hold a significant amount of cash in short-term investments, it is a little bit less than they did 5 years ago. Numerically, directionally, you know the drill. We're looking at their total debt. It has lowered from 44 billion, which is relatively high in comparison to their cash, to around 42 billion. So whilst their cash has marginally fallen over the last 5 years, so has their total debt. So no real drastic changes over the 5-year period, and we'll shortly look to see the net debt to EBITDA metric. So looking at other competitors in the soft drinks and non-alcoholic beverages, we have PepsiCo, Monster Beverage, Keurig, Dr. Pepper, as well as a few well-known others. Over the last year, we see Coca Cola up 1%, so this is total return, includes dividends reinvested. In fact, half of the industry hasn't performed that great over the last year. We see, in fact, PepsiCo down 3%, and when we expand this to the last 5 years, we see Coca Cola up 39%. Not really great in my own opinion. Over the last 5 years, you want to be looking at more than 39% on any return on investment. Pepsi, on the other hand, 70% isn't too bad. But again, you want to be seeing around that 100% level. So let's take a look, and also just bear in mind, which I didn't forget to mention, past performance isn't an indicator of future. So while it may not have been great performance over the last 5 years, that isn't to say the next 5, 10, 20 years will be much better. Institutional ownership for KO, 69%, 10.5 billion worth of sales by these institutions over the last 12 months, more than double at 22 billion during the same period. So institutions, they do like this company. It is one that they do hold in their portfolios. And we can see Q1, Q2 and Q4 more buying than selling by these institutions. Q3, the only quarter last year where there was more selling. And in the more recent quarter, we see a lot more buying than selling. As always though, remember this is just information shared. You always need to do your own due diligence and never copy what anyone, especially the institutions, are doing. Now, one thing, we did run Coca-Cola through the buyer and sell insider management screener. We're looking for any buys and sells, at least 100 shares within the last 3 months. And we can note quite a fair amount of selling. In fact, when we total this up, just under $20 million worth, notably by the chairman and CEO James Quincy twice over the last 3 months. We also have Henry, the Senior Vice President, and Beatrice, Executive Vice President. But what is quite important to note, and this is something that I do mention quite a lot, insider buying, insider selling. Insider buying is bullish signal. It means that management are buying because they believe the share price will go up. Insider selling, many reasons why they want to sell. This could range from personal reasons or financial reasons. So whilst we do show these information, just bear in mind and take it with a pinch of salt, and always do your own due diligence. And this ties in quite nicely to our free weekly newsletter that we send out. Last week's edition was in fact running through examples where companies and managements were buying a lot of shares, and also some where they were selling a lot of shares. If you want to grab a copy, completely free, sign up on the link below. We've also done articles discussing our 7 golden dividend metrics, talking about how to identify undervalued companies, as well as a few others. So let's now jump into the dividend safety. A score of 80, it is safe. Market cap 258 billion, a mega cap company. In terms of key recessionary metrics, well, they increased the dividend during the last recession. Above average growth, negative 5% versus negative 12 of the S&P. And they also outperformed the S&P 500 with a negative 31% versus the S&P 500's negative 55. Dividend growth with Coca Cola over the more recent period, very, very consistent. 4.5% last February, so pretty much in line with inflation. Remember, it's important. I always say on each episode, you want to be getting at least 4% or more. Now, this does extend to your salary, your dividend, your other income producing asset, because the US inflation rate over the last 40 years was 4%. If you are getting less than that in any of those income brackets, you are getting a pay cut and losing your purchasing power. So nice to note for Coca-Cola, at a bare minimum, they are keeping up with inflation. Over the last 20 years, 8%. So in terms of dividend growth, they are a dividend king. They have increased those dividends for 50 years or more. And on top of that, they have been paying dividends for the last 103 years without a reduction. In terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. So in my opinion here, we have reasonable valuation. But when we look towards the forward PE, 21.5 versus 24.2, this is an undervaluation signal. So bear in mind, we never look at any of these models in isolation, and we will conclude towards the end. We can also see the consumer staples sector PE slightly lower at 19.2. Now, for those that are new, we do draw your attention to the free cash flow payout, as earnings is susceptible to manipulation by management through accounting. We've gone through a ton of examples, and we will continue to do so on the channel. But for now, we're looking at below 70% for consumer staples. That is industry specific. For me personally, I like to see 60% or lower, because it gives me faith management are able to offer those double-digit dividend increases we love to see. Clearly, with Coca-Cola, we don't expect double-digit increases, and it's pretty obvious their payout is 80% pretty much over the last few years. 2023 and 2024 expected to be just below that at 77. Free cash flow per share then, it has increased over the period, but again, always bear in mind what type of companies that you are investing in. Coca Cola is a mature company. You will not expect the same free cash flow with Coca Cola that you would, for argument's sake, for Microsoft or Nvidia, different type of companies. Nonetheless, over the period, it does increase. 235 in 2023 expected, 238 in 2024. Sales growth, 2013 to 2018, it was just negative growth to the top line. The last 2 years, double digits. The more recent year, 6%. Not too bad. But again, it's important just to understand the type of companies you're investing in. 47 billion on the top line in 2013. 45 expected in 2023. They do some share buybacks. They do return some excess cash to investor pockets, reducing it from 4.51 billion to 4.34. So let's take a look at the ROIC. Now again, if you do subscribe to the free weekly newsletter, this is one of my 7 golden dividend metrics. I want to see 10% or more. Part of that, it gives me faith that management are able to effectively allocate their capital. Nice to note for Coca Cola, it has in fact been increasing. 18% in the last year as well is very nice to note. Operating margin, free cash flow margin, pretty similar story on both. They seem to be increasing over the long term and already above those minimums that we like to see. So very positive, no red flag indicators to note so far. Net debt to earnings before interest, tax, depreciation, amortization. For those that are new, it signals 2 things. Firstly, the dividend safety. Secondly, the balance sheet strength. 3.03 in 2020, 1.8 in 2023. 1.7 expected in 2024. No worries whatsoever. That dividend, based on the information we have, seems to be safe. Balance sheet as well, nothing to note there. So let's jump into the valuation of Coca Cola. As always, if you're enjoying the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Starting off with the first model that we're using is the multiples valuation. We have the stock ticker symbols and the PE multiples of companies in a similar sector and size. We have their average, multiplied back by the EPS of Coca Cola to get an intrinsic value of $73. As we can see, our first undervaluation signal, but bear in mind we're not looking at any of these in isolation. The second model we're using is the dividend discount model, where we have the yearly dividends from Coca Cola. The average is 3.4%. Now, over the last 2 years, we've seen 4.5 to 4.75. Forward looking, I've gone a little bit more optimistic at 5%. I am hoping they do start to increase this. And this gives an intrinsic value of $64.40, market value 40. So again, we have an undervaluation signal. In terms of the DCF model, we have those free cash flows year on year, average growth rate, forward looking in line with analyst estimates at 10%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We have another sign of undervaluation. So the intrinsic model for today's episode is just the average of these 3 models, and it's coming to $68. As always, if you click on that pinned comment below, you can grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or on your watch list. Now, we start off with a margin of safety of 10%, which is what we use if we believe it has a wide moat, strong financial metrics, and good forward-looking data. Based on this, it is a buy up to around $61. So in reality, we see around a 10% current margin of safety for Coca Cola. In terms of Wall Street and their price forecast, well, over the next 12 months, they see a price of $65, so they see upside of 9%. As always, let me know your thoughts in the comments below, whether or not this is one you are looking to add. Now, for me, whilst this may be one that I would add in my portfolio, I would need a much higher margin of safety. Given the fact that the yield is 3%, the growth on the share price, as we saw over the last 10 years, isn't that great. In fact, a little bit underwhelming. This would need to be at a significant margin of safety. So for me personally, whilst this may have a 10% margin of safety, this is one that I would personally wait for a much, much higher point. As always, have a great day. If you enjoyed today's episode, smash that like button. And as always, I'll see you on the next one.